What is crowdfunding and how can it be used to fund a business venture? Well, to begin with, there's really two types of crowdfunding. One is donations and the other is a form of equity funding where you're actually selling an ownership interest in your startup venture. The first form, donations, it's really where you're asking people to donate money to the business in exchange for some special privileges like early access or something like that. In many scenarios, it's been converted kind of into a pre-selling platform where you're saying you can agree to fund the development of my product or service, and once it's funded and it gets developed, we'll sell you the product or we'll give you the product as a perk or benefit for you having funded the business at a given level. And so say you funded at $100, you get this product. You funded at $1,000, you get this other product. So in a way, it's pre-selling the product ahead of time, but it's structured in a way that it's actually donations. The one we're going to focus on is equity funding. And this is where you're actually approved to sell an ownership interest of your company through a crowdfunding platform. Okay. So generally selling a interest in your business, selling a security, stock, a bond, a convertible note, something like that, anything that constitutes an investment in your business where the investor's depending on your actions to draw profit. This is an investment contract, and under that scenario, it's a security. So selling an interest in your business is a security under the Securities Act, and it's generally the business must register or go through the registration process with the SEC for the transaction and the security prior to selling it to individuals. Now, the Securities Exchange Commission allows numerous exceptions to the registration requirement, and most funding transactions are completed pursuant to these exemptions. Most of the rules are authorized under Section 4 of the Securities and Exchange Commission statutes. So Section 4A6 particularly has been interpreted to allow for the sale of interest through crowdfunding means. Now, generally the limitations for the crowdfunding exemption is that a business can't sell more than $5 million worth of securities over a 12-month period pursuant to the exemption. If they want to sell more than that, they can. They just have to go through the registration process, and which is very arduous, time-consuming, very expensive. So it's important to stay within the exemption rules. Part 2, you have to limit the number of non-accredited investors that can invest through crowdfunding. That means there's only a certain percentage of the interest you're selling, a certain number of shares allocable to a certain number of individuals as part of the offering. Okay, you have to make informational filings with the SEC, investors, and other intermediaries. And very importantly, you can only carry this out through an approved intermediary, that is a crowdfunding platform that has registered with the SEC and makes full informational filings and disclosures to the SEC on its actions and practices. So while the company must remain within the Securities and Exchange Commission rules, also the intermediary and the platform must be approved and regulated according to the SEC rules for offering securities in a crowdfunding format. And then the securities purchased generally cannot be resold. They are restricted from resale for a 12-month period following the offering. And generally, if a company complies with these rules and stays within the provisions of the crowdfunding regulation, then again, you are exempt from registration with the SEC, and you can crowdfund and raise money by selling an ownership interest in your company through a crowdfunding means or platform.